Hey guys, what's up? This is Kyle from The Finance Major. This website is dedicated to simplifying finance for undergraduates. As a recent grad, I know there's a ton of resources out there, and to be honest, it's pretty overwhelming. You've got hundreds and thousands of websites for students and finance professionals right at your fingertips, but yet so many students still feel completely lost. I felt the exact same way when I was an undergrad with no direction. So really this website was built for you, the finance major. So because finance is so broad and there are so many different avenues you could go down, today we're going to be covering the four main categories for finance majors and covering some of the more popular career paths that finance students actually end up pursuing upon graduation. So let's get started. So let's cover the four main categories for finance majors. First we have accounting, corporate finance, investment banking, and investments. In audit, you could get exposure to many different companies, learn the way they operate from the back end by learning their processes, systems, and controls. Note that travel is very common in this field and auditors are very fond of flowcharts and controls. Tax is a little more self-explanatory. You could be working for a CPA firm, preparing taxes or keeping books for individuals, working for a large public accounting firm, managing taxes for companies. This field tends to be pretty narrow in focus, and it can be tough to change career paths once you're already in too deep. People working in tax generally prefer working individually rather than working in teams. In my opinion, if you're going to be working in accounting, I think the best overall experience would be in consulting or advisory services. However, these roles usually are much more competitive than tax or audit. Basically, consultants advise clients on certain business activities, or they provide temporary support for longer-term projects for companies. Consultants can sometimes be viewed as rental employees because of this. Tax and audit tend to be pretty popular among undergrads, but that's because the Big Four accounting firms recruit so heavily for these entry-level roles, and many universities have well-established funnels to these companies. Tax and audit internships and jobs are generally easier to get than consulting. Part of the reason for that is because tax and audit roles are much more well-defined, whereas consulting requires a lot more intuition and a broader range of skills and capabilities for the job. Major companies in accounting, I'm sure many of you already know, the Big Four, Deloitte, Ernst & Young, known as EY, PricewaterhouseCoopers, known as PwC, and KPMG. So moving on to corporate finance. For financial planning and analysis, think budgeting, revenue, expense projections, forecasting, cash flow management, return on investment, which is ROI, internal rate of return, which is IRR, cost of capital, etc. So for internal audit, this differs from audit or external audit in that you're actually auditing the company that you're working for. Again, flowcharts and controls are a must here. They're mainly concerned with evaluating and improving risk management, controls, and governance processes. In corporate accounting, you're basically keeping and managing your company's books and financial statements, including the three main financial statements for a company, which every finance major should know. This is the income statement, the balance sheet, and the statement of cash flows. This could also include managerial or cost accounting, so managing projects, inventory, costs, etc. The major companies that I think of are Procter & Gamble and IBM. Again, these are just two of the many companies in corporate finance, but almost every company in existence has some type of corporate finance function. So next we have investment banking. This is Wall Street. This is the sexier side of finance. Many undergrads earlier in their college careers would never admit that they couldn't explain the difference between a retail bank and an investment bank. And many of you probably already know the difference, but I'm still going to mention it anyway for those who aren't entirely sure. In general, a commercial or retail bank basically provides services to individuals and small businesses, whereas an investment bank operates on a much larger scale, providing services to large corporations and high net worth individuals. So sales and trading is exactly what it sounds like. In sales, you're basically establishing relationships with clients on behalf of the firm to gain their business and sell your products, which are securities, to them. In trading, you're literally buying and selling securities either on behalf of your client, which is known as agency trading, or on behalf of the firm, known as prop trading or proprietary trading. Traders are often known as market makers because they provide liquidity in the market. In general, it allows investors to get in and out of positions with relative ease. Keep in mind that prop trading took a massive blow after the 08-09 financial crisis due to regulation. Most prop trading desks moved out of investment banks and into hedge funds due to the Volcker Rule, which restricts U.S. banks from making several types of speculative and incredibly risky investments with the bank's capital. The number of sales and trading roles have generally shrunk in size over time due to increased regulation and algorithmic trading. Algorithmic trading basically involves writing complex mathematical code so that computers can make trades with a limited human intervention. Equity research, explained simply, basically means performing research on public companies and providing a buy, sell, or hold recommendation for each company's stock or equity. You're basically digging into a company's financial statements, building financial models, producing reports with that information. The goal here is to create an insightful equity report that your firm can sell to clients. So think of capital markets as the market for capital or money. In a general sense, this involves helping companies raise capital by issuing debt in the form of bonds or equity in the form of stock. Companies often raise capital in order to fund expansion. For example, a startup may approach an investment bank in order to help them launch an initial public offering known as an IPO. An IPO means that a company is issuing stock for the first time, and this puts a ton of pressure on bankers to price the company correctly, or else the reputation of both the startup and the investment bank can be damaged here. Who gets excited about a new company that appears to be on a downward trend? And who wants to do business with an investment bank that can't do their job? If you want to read more on IPOs, I would read up on Blue Apron and the Snap IPO. So capital markets bankers and investment bankers often work on the deals you're going to be seeing in the Wall Street Journal headlines. Snap issues IPO, Amazon acquires Whole Foods, etc. The investment banking department within an investment bank is closely related to capital markets in that you're actually advising the companies through certain transactions. This field is incredibly competitive, it can be incredibly lucrative, but the hours can be incredibly brutal. Investment bankers provide advisory services for companies involved in mergers and acquisitions, known as M&A, or restructuring deals. And restructuring is basically determining the optimal capital structure for the firm, so finding the right balance between debt and equity. The use of debt and equity both have pros and cons, and each company has different needs. Some of the major companies, as many of you already know in investment banking, are Goldman Sachs, JP Morgan, Morgan Stanley, Bank of America, Citigroup, and some of the European banks, the foreign banks, include Barclays, Credit Suisse, UBS, and Deutsche Bank. And last but not least, we have investments. So financial advising involves advising clients on their investments and managing their money. In general, financial advisors help individuals assess their goals and risk tolerance, aligning their portfolios to meet those needs. A financial planner is similar to a financial advisor, but a CFP manages most, if not all, of a client's finances. So this would include investments, taxes, retirement. They both fall under the same umbrella, but a CFP provides more of a holistic approach to the investor's needs. So investment management sounds like a very broad category, and that's because it definitely is. It's kind of a catch-all here. This involves investment and asset management firms like Vanguard that create and manage investments like ETFs and mutual funds. So an ETF stands for Exchange Traded Fund. So it trades basically like a stock. There are just some minor differences. These companies often have the ability to manage clients' money, providing personalized services to individuals with assets over a certain threshold, and providing robo-advising services to people with assets under that threshold. So if you want to succeed in providing investment services to individuals, you need to be very good with people. I've spoken with several people from the industry, and everyone says you're almost more of a counselor than a financial advisor. So some of the major companies that I think of in this investments category would be Vanguard, Blackstone, and Edward Jones. I'm throwing Edward Jones in there just because they have so many retail locations across the US, and virtually everyone knows them. So that's it for today, guys, but I hope you learned something, and I hope I was able to simplify the main categories of finance for you. Please let me know if there's a concept or topic you'd like me to cover next. Thanks for listening. We'll see you next time.